This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, welcome to another edition of the Alternative Investing Advantage podcast. My name, as always, is Alex Perny, and today we're very pleased to welcome on Amir Baluch with Baluch Capital. We're going to be covering a lot of interesting topics today. It's very rare that we kind of get to talk to people in the space that he's in that are, anything but maybe lukewarm to extremely cold on alternative assets, and that's certainly not kind of the viewpoint that is taken over here. And again, certainly what we do here as an adjunct to the podcast at Advanta IRA, it's all we deal with is alternatives. So it's always refreshing to have someone on to kind of give their viewpoint and how this asset class in general can fit into a portfolio, and especially from a risk mitigation standpoint as well, because so many people, come to the alternative space with a degree of skepticism. Real estate, being the main alternative asset's always seen as pretty safe. But once you kind of branch out of that into alternatives, there's many different ways to look at it. And a lot of people have a very skewed viewpoint of that. So again, very excited to kind of dive into some of these topics with you today, Amir. If you wouldn't mind, give us a little bit of background about yourself, because you have a pretty interesting trajectory from how you came to be in a financial services role from where you initially started. So if you wouldn't mind kind of starting there, and then we'll go forward.
Got it. Yeah, thanks for having me on. And yeah, it definitely wasn't the traditional story, and it's not what I thought that when I was in high school. Hey, I would grow up to be in the financial space of some sort. My goal is just to be, a doctor, kind of like my dad was. And, now I'm a semi-retired anesthesiologist and founder of Baluch Capital, which is a multi-platform or multi-asset platform dealing in alternatives and all a bunch of non-correlated assets. And we'll talk about what that means. But, originally my goal was just to become a doctor until around the year 2000 when I applied to medical school and I didn't get in. So I was like, well, that kind of sucks. So what am I going to do? And I had my life savings, whatever little that can be when I'm 21, I put into an electronics payment business, and that didn't work. I was going door to door, not knowing anything with my biochem degree about a business. And then I decided, let me regroup and reapply, and I'll go move back in with my parents, right, and do the safe move. So 2 months after I moved back to my parents, my dad, who's an internal medicine doctor, went bankrupt. We moved to a one-bedroom apartment that was $250 a month with barely any hot water, and it wasn't very fun to all be cramped up in there. So then I thought to thinking, I better not let this happen again. How do I prevent this from happening? I just started learning about personal finance and business and leadership, and then investments in general. How do other people make their first $1 million? Because I didn't get into medical school, and here I am, I lost out in business. What else am I going to do? So of course eventually I did get into anesthesia, in anesthesia residency in medical school, and I finished in 2010. I moved to Dallas, which is where I'm at, and I immediately got my real estate license, since after doing some research, I found that most people make their first $1 million in real estate. Then, just to learn even more about investing in general, I got my securities license and joined a boutique investment bank. I was a registered rep on the broker-dealer side, where they deal with private securities. So I did that for almost half a decade, and that was the real education for me, is seeing how people are doing hundreds of millions of dollars in transactions, and people with solid track records and understand risk, reward, and just learning that firsthand from some of the best people was really the key. Now, around 2016, I decided to go off on my own after we did almost $1 billion in transactions with multifamily, hard money lending, some private equity. And we focused on real estate development here in Dallas, Texas. And we started a few, I think we're on our third life sciences / biotech fund. We've had some fixed debt income products and some other alternative assets that are pretty unique. And that's kind of where we are right now in 2025.
No, great. It's certainly an interesting trajectory. I've talked to a few different people that have, gone, "Hey, I was in corporate America and then I discovered real estate, or I discovered kind of the alternative space from a few things." I think you're probably the first person with a medical degree that's matriculated from that end over to the finance side. So definitely interesting to kind of get some perspective there. Now, from starting it again at a high level, we talk about non-correlation. I think that's really going to be kind of the key of what we're going to focus on today. Especially when I tell my peers, when for the ones that actually get past me saying, "Hey, I'm in finance," and I'd say something other than the stock market and their eyes kind of glaze over. For the people that make it through that, right? I talk a lot about diversity, and everyone kind of hears, if you went to it took any intro to finance class. So, like, the best way to mitigate it's put the newspaper stock chart up there and throw a dart at it. Get diversity, right? And while that's all well and good, you have the ability on the public markets, and I don't try to make these statements to disparage it. There certainly is a very valid point to have this as part of your portfolio. Some of these companies, again, have been around for over 100 years. I mean, hard to argue with what Coca-Cola's done, right? But when it comes to non-correlation and true diversity, all these different stocks are on the same basic marketplace, and things can affect that. You might be invested in Coca-Cola
Right.
and then invested in a mining company, right? There's not much that you can correlate between pulling earth minerals out of the ground and making a soda, right? They're not too correlated, but
Mhm.
you have something that comes along, like, again, maybe the attacks on 9/11, or you have something that comes along like the unrest in Ukraine, or anything else that's large and geopolitical, can cause the entirety of these markets to dip or maintain a depressed status for a long time. So
Right.
being able to invest in non-correlated assets, again, things that, one, are not correlated and maybe aren't sold in the same place, is a powerful tool. Now, from your perspective, where was some of the kind of the initial things where it opened your eyes to that concept of non-correlation? Maybe if you had like a few different things where you kind of initially had an aha moment with seeing how real diversification and non-correlation can really be a benefit to investors.
Well, what I realized it really was just about 15 years ago when I did get my securities license and I was getting into real estate, mainly multifamily and some fix and flips. People were kept on telling me, "Hey, when stock market goes up and down, we're making consistent money." For example, when you're doing hard money lending, it's pretty solid, 9 to 11% returns, depending on what exactly you're doing. And it didn't matter if Elon Musk sneezed on Twitter or something like that. It was pretty consistent, and you had a hard asset. And back then I was thinking, okay, well, okay, I got my diversity. There's stock market, but I got the real estate. So, but then I realized it's even more than that because even though there are different variables that affect real estate, different variables that affect the stock market, there's so many other asset classes. Even I wasn't even exposed to them at that time. I even had the blinders on for real estate for about half a decade. I didn't even really look at anything else, although I knew, oh, I could invest in a business, and I know there's some fixed income products and things like that. But one key thing for everybody listening, I think, is to understand what non-correlation actually means. So you were kind of hitting at it a little bit by talking about what variables affect an asset class. So, like in 2008, some people felt, oh, well, I got some large caps, some small caps, right? I'm diversified. But when that asset class is down, usually the whole asset class is down. So that diversity inside of the asset class is not what protects you. It's the diversity of asset classes. So, for example, real estate might be affected more or less by interest rates and by inflation. Usually, it's a good hedge against inflation because actually the materials that make up real estate will go up in price, and so they have to sell the house for a little bit more. And then you have other variables if you're in international markets or if you're doing commodities. So if you look at all the risk variables for everything, they don't affect all asset classes the same. And so when you have asset classes that are non-correlated or even inversely correlated, now you have true diversity. You can't just have one thing go bad and now your whole portfolio is down. And sometimes if one thing goes bad, something else is better. For example, when people are fearful uh, and emotionally scared, the stock market will go down. But if you had something like gold, that's going to go up. Or if you have some money in bonds, that's traditionally going to go up. People rush to those. So that's really the key. And it all kind of came from a guy named Markowitz. He won the Nobel Prize for portfolio theory. And he showed mathematically, and Ray Dalio, who's a big time hedge fund manager, one of the best, he talks about it in his book Principles. But whenever you diversify your portfolio across 8 or more non-correlated or lightly correlated assets, you actually reduce your risk by up to 80%. So let's say the return is the same, but the risk goes down by 80%. That's basically a 5 times higher uh, reward to risk ratio just by focusing on getting into other asset classes. So, and if that's the case, you don't get blown out by just being a one asset class, because a 20-30% dip in your portfolio might take half a decade to a decade to get back to zero. So I think that's the main thing to understand about correlation ratios, is that it can really have a strong, powerful effect on your portfolio in the long run and prevent you from getting pushed back on your timeline for retirement or partial retirement by a decade.
Yeah, and I really like kind of the example you make of saying, look, like your rate of return being X across a certain spread of funds, but if you can reduce that volatility factor, then how much more valuable is that? Again, the unknown is the unknown, but the potential for that, percentage of like that target return to be met is almost an exponential growth at that point. If you can reduce
Right.
that risk factor by, again, up to 80%, again, that's, opinion. But again, it just really kind of goes to show when you can break that correlating factor between your asset classes, the stability of those returns that you can make goes way up, and your ability to hit those return markers goes way up as well. It's not necessary not necessarily just looking at your rate of return, it's your realistic expectation to be able to make that. I think people way undervalue that when it comes to picking asset classes. And another thing
Right.
that you mentioned too that I didn't really kind of, I like little light bulb moments, but people too often look from the perspective of, hey, what I'm investing in. But if you take a step back, you can really make a lot of informed decisions by looking at what are the external risk factors to what you're doing. Okay, so if I'm going to invest in something and interest rates are crazy, let me do this. Okay, well, when interest rates are not going to continue to go crazy, what industries that are not correlated to this are going to do better? Okay, well, maybe let's do something here. So looking at it from, again, a very high level can be very good. Again, we all get blinders. You've had them, I've had them, and the more times you can kind of hear people kind of mentioning things, again, my goal is to try to help the people to realize things. And I think looking at things from a risk factor standpoint to help drive those investment decisions is also probably a pretty good avenue to take with that.
Right. Right. I agree.
So moving on from that, again, we kind of, real estate is something I think, we both know and love. I wish I had the exact numbers on how much real estate I had a hand in earlier on in my career when I was kind of sitting the desk and doing investments for clients. But, rough napkin math, probably easily $250 million worth of transactional mass that I handled, which was really cool to see, especially in the timeline that I was doing it, 2012 to 2015 or so, and just all the cool stuff that happens with that. But again, changing markets necessitate looking at things a little bit differently. Now, the things that I kind of want to transition a little bit out of from the real estate flavor that we were talking about, you mentioned some other things such as like fixed income and fixed debt investing. I think people probably heard these terms before, but as it fits into something, how do these things, again, building on real estate, how do those asset classes differ, and what exactly are those?
Well, so we talked about real estate. We'll start there as an example of what could be a fixed income product. So, for example, what if, and I'm actually thinking about doing this maybe this year, but let's say if I wanted to replace the bank. Because most people, when you do real estate, you're going to get a loan from a bank, and they're in first position, which means they're the first ones to get paid after a sale, or if something bad happens, if there's a fire sale, they're the first one that gets paid. And usually they're going to charge a fixed interest rate, 4, 5, 6, 7%. Right now, construction loans are around 10.5%. So imagine if you could invest in a fund where you're the bank, and maybe you get that fixed 8, 9% in your portfolio, and you're in first position, versus in most real estate syndications, you're in second position after the bank, and you're hoping that the equity after the bank gets paid is enough after the split to hit your returns. Maybe, I think the average for commercial real estate was around 14% a few years ago. I don't know what it is now, probably a little bit less. So, in that case, you could say, oh, I could take the risk of being in the equity position and get 12, 14%. What if I could just do the first position risk, and take way less risk and get 9? Is pretty attractive risk reward ratio, and and now you have a fixed a portion of your portfolio that's pretty much fixed income. We also had set up a few years ago an arbitrage play on e-commerce inventory lending, where basically we would charge a certain percentage a month, and then the investor could get 50 to 80% of that as a fixed income return. And the cool thing with the arbitrage play is that basically arbitrage off their profit margin is what it was. This thing really isn't correlated with anything. Actually, if interest rate goes up, we could probably charge more, so that would be in our favor. But it doesn't matter who the president is. It doesn't matter geographically where you are. So it doesn't matter what somebody says on Twitter. People are going to buy things online at a certain price, no matter what, and make a profit margin. We're getting a piece of that by lending to them. So those are a couple examples of fixed income products that are not sensitive to these other risk variables that mainly are affecting the public stock markets or even traditional real estate syndications. So that's something that I think, if you look at the Tiger 21 portfolio or Harvard and Yale endowments, they usually have around 10% plus or minus in that asset class for that reason. Just like there's usually a high single digit or low double digit fixed return that doesn't have so many variables that can affect that rate of return.
That's really interesting. I've never really heard of people kind of doing floor plan lending on like e-commerce stuff. I grew up, with my family in automotive and automotive sales and, owning dealerships and stuff. So I'm kind of familiar with like inventory lending on, again, larger scale things like, cars, trucks, things like that. But I would never really have thought, from the perspective of that being in, a play for arbitrage on e-commerce. Now, from that perspective, are there other industries that kind of utilize that model for like inventory lending for like arbitrage events like that, or is it mainly just kind of really popular in the e-commerce space for inventory right now?
It's definitely getting popular in e-commerce, but another version of that, which you might see in other industries, is they'll lend on in other industries by factoring. So what factoring means is you have some type of asset. Sometimes the contract is the asset. Hey, let's say in the trucking industry, once I deliver this product, I'm guaranteed to get this amount once the thing is delivered. So you could give that company some upfront money to finish that route and charge 1.5% a month for that. And then once it's delivered, then you're the first person to get paid out of that. So that's something called factoring. People do that for invoices too. And actually a big one now, which I haven't gotten into yet, but I know it's getting pretty popular, is litigation financing, right? So let's say an attorney group has a 30% win rate based off of how many cases they have. They can expect to have X amount of money, but some people might want their money now, like in a personal injury case. So you could pay, for example, the physicians now, let's say $500 for a steroid shot or something. I'm just making this up. But when the case is done, maybe that steroid shot pays out $1,500 or something like 3 times as much over 6 months. So now over 6 months, there's a lot more money on the table. and you could be financing that attorney group as they do the litigation. So that's been pretty
I've
popular.
interviewed a few people that are in litigation finance. One of the big ones is I think it's Fort Pendleton, or I can't remember which army base had the water issue.
Huh.
That, as well as the what's is one of the biggest Bestos settlements as well. But the really cool part about those things too is that once you've gotten there's different ways that you can actually like, and the cool thing is that there's like different like risk levels to that, because there's different kind of tranches of where they take in financing for those. So you can come in for something that maybe has a little bit more early on in the class action or something like that. They need money to fund the actual action that they're bringing in the case, and it really hasn't gone too far. They haven't gotten sent down with a judge. They haven't really had much to, they're just doing discovery, and you can make a really big multiple highly risky though. And then there's also ones where it's gotten to the point where, okay, now we have basically the opinion of the judge, that we know that this is going to be settled. We just don't know the actual amount, but we're still having to do work. And again, your spread on that's going to be significantly smaller, but you have almost some type of guaranteed payout. So it's
Right,
something I
right.
never realized was actually out there, and it's growing pretty large considering some of these tort cases are just massive in scope. I mean, you're talking about multiple billions of dollars in settlement. It takes a lot of money to bring a case like that to fruition, right? So
Right.
figuring that out is something really cool that I never realized was really something you could invest in. I mean, I've seen a lot of weird and interesting alternative investments in my career. When I say weird, I mean weird. But the litigation financing is something I definitely find an interesting perspective from something. Again, that's not necessarily going to be a fixed income. That's more of again kind of a hope, and put it out there. It will maybe pay a return. There's not a whole lot of security on returning your basis on some of those aspects. Again, stuff that's
Right.
maybe matured a little bit in those cases can definitely pay out. But you want to talk about a non-correlated asset class. I mean, again, doesn't matter what someone's saying on Twitter, doesn't matter whatever's going on, the courts are still going to run.
Right, right.
And that settlement's going to come in, and there's really nothing anyone can do to stop that. So, you know, what I like especially about the alternative space is that it does offer, again, to that point of being able to really draw in that, you're not going to get a litigation financing investment just looking at your stock portfolio on, Fidelity or Merrill Lynch. It's not going to
Right.
happen. But again, when you get into the alternative space, it really does help to drive that home. Now, again, kind of going, from there, there's a lot of different ways to invest alternatively. But what do you really feel, besides kind of from what you've seen as a benefit to clients, is one of the real big benefits besides, again, just risk? There's definitely some other, again, a little bit harder, a little bit more intangible aspects that are kind of offered by being able to, break out. What are some other benefits that this kind of investing can offer to people that are looking to maybe make a change and rebalance their portfolios out of maybe just being in the stock market?
Well, maybe we switch gears to private equity a little bit. I think it can be fun and actually lower risk. So, for example, in private equity, I'm mainly playing in the life sciences space because my medical background, it's easy for me to see if something has product market fit and will people in the healthcare space adopt it. So now I'm in the private equity space, which has outperformed the S&P every year for the last 35 years. It just happens that biotech and life sciences is the highest performing industry in private equity, and it's something that I know. Now, it doesn't mean you need to go out there and invest in life sciences, but let's say you are a specialist in a certain industry. Let's say it was construction. You can go out there and you could probably buy into and invest into some construction companies, or maybe somebody's doing a construction company roll up. What's a roll up? That means they're buying a bunch of smaller companies in that industry and putting them together to make a massive company that can maybe go public or sell to a larger private equity company. So if there's a background, if somebody has a background in a certain industry, you can use that to your advantage and find people that are buying up businesses in that industry that you know. The reason I bring that up is now you're using your expertise from your job or from your work to decrease risk on your investment, right? Because a lot of people say, hey, just invest in what you know, which is, if that's the case, you're not going to know everything. You might never be truly diversified, right? So, but this is a chance where, forget about the S&P, use your knowledge of your own industry that you're familiar with and get into some private equity markets in that industry. So, and it makes it fun too, because now you could be more involved. For me, uh, I've become a strategic partner with these companies. A lot of times I can negotiate better share classes and terms for my investors. Sometimes we've gotten, share prices down 70, 80% below market price just for me coming on board and bringing my physician network. So there are things like that you could look into in the private equity space, and it makes it more fun.
Yeah, and there's a lot of benefit to that too, and there's definitely people kind of doing some interesting things. An easy one, I interviewed a gentleman named Tim Donovan with Midlock Investments, and they do commercial real estate. But a cool, interesting part about what they do is that it's kind of like a hybrid mutual fund ish thing where they basically come in and they say, okay, we're gonna go out and invest in commercial real estate with this fund, but we come in from the perspective of taking you can't have a controlling interest as a limited partner, but taking a significant part of that capital stack so that way they have negotiating power for operational matters, also for, rates of return, how things are paid out, maybe negotiating a slightly higher, percentage of a waterfall of it and things like that. And being able to do that in the private sector is apparent. And again, it's not just, from a perspective of doing something like that, but, investing in what you know, again, I don't know what I know, right? I know enough about too many things to be dangerous in any one of them. But a lot of people, again, if you're a physician or if you're an engineer, you have very inherent important information that can really help you invest in something that, not all these companies are, you know, publicly traded. And you can't necessarily go up and talk to the managing director or the CEO of a company by any means if they're publicly traded. But with private equity, when you're talking to these companies, they have a direct need for your capital. If you're publicly traded, capital kind of makes itself available, if you will. It trades, you're
Right,
there.
right.
But, you get to have that one-on-one kind of conversation with these people. And again, it may not necessarily be the top of the food chain you're talking to, but it's going to be someone that can answer your questions and really help to kind of peel back the curtains and help you understand what's going on and what the benefit might be. And especially if you're in a position too, I mean, easy ones to pick on are doctors, engineers, maybe attorneys if you're doing litigation finance, but where you have specialized industry knowledge that can really help you to identify better fits and also potentially become a strategic partner. You can not only make money on your investment return, but potentially get brought on in a consulting capacity too. And people
Right.
often overlook that aspect of private equity. And again, private equity is kind of a nice, big, sexy term, right? We hear people like Sequoia Capital and these people, but it's not just people investing in early stage Facebook or Uber, things like that. There's tons of companies need capital, right? And it might be they need $10 million, they might need 50, they might need 1 million. There's so many different avenues for opportunity that really get you that hands-on experience with this that is often overlooked, and I don't really think enough value is placed on that. Again, it really kind of you know that's one thing I really am always kind of confused why people don't necessarily grasp that portion of the concept of this particular segment. But additionally, with private equity, what I'd like to kind of get your thoughts on are, you mentioned, the outperformance and the correlation between, what the S&P index has done versus private equity. Where do you think some of the like why that happens? I know that's an impossible question to answer within this
Mhm.
time frame or maybe even ever, but at least from looking at the delta between the ROI between the two over the past however many years, it's pretty stark. And what do you think some of the big reasons for that are?
A couple reasons. One reason is the access. Let's say if you want to invest in Tesla, just go online and push a couple buttons and invest and as much or as little as you want. You can invest $100, right? When it comes to the private space, $100 probably not going to do it. Although I know there's some crowdfunding sites out there where maybe you could do $100. Usually you have to be an accredited investor or qualified client or qualified purchaser and probably put in at least 100 grand, maybe 50. So I think access is one thing. Were you invited to it or not? So before the Jobs Act, everything was 506B. You couldn't market it online. So if people are not aware of it, and these private companies can't make you aware that they have an investment opportunity, how are you going to know? Right. So now with the Jobs Act, it's getting a little bit better. But also, if you want to be proactive at it, if there's a certain industry you want to get into, you can go out to certain industry events and you'll find some opportunities that way. Another issue is just the traditional uh, the traditional way of investing, which is, hey, get with a financial advisor, park your money in some mutual funds, and we'll see you in 40 years. And it's kind of interesting the reason why. I don't know if you know or the audience knows why retirement was even invented. If you go to some other countries, there's no retirement, right? But I think it was like in the 20s or 30s, people were thinking, hey, people are living longer, and when people come back from World War I or two or whatever it is, there's not going to be enough jobs for for the younger people unless we force kind of the older people to stop. And so they created this term retirement, said, hey, you guys need to save up so you could give up your job to somebody younger. If you like doing what you do, then maybe you should just keep doing it till you die, right? But when this issue of retirement came up, that's when people were thinking, wait, I need to have a plan because at some point I need to stop working. And then the easiest access point is to invest in these larger companies where, even before the internet, you could just make some phone calls to a brokerage, or, the whole financial advisory industry came from that. And basically just charging AUM fees for access to something that at least right now you could get online by yourself. But that traditional way of thinking is what people know. And the last thing is liquidity. So in most alternative investments, you don't have that much liquidity. And there's some people that they do feel that they like to have access to their cash if they need it by pushing a button. So you got a couple $1 million in your brokerage. Wow, if you need the money, you just push a button and you get it. That's not the case if you're doing a 5-year real estate development, right? Well, that's not going to happen. Or if you're doing litigation finance and in the fund, it's a 1-year lockup or a 2-year lockup. So the summary is basically, access, knowledge, uh, traditional way of thinking, and the needs for liquidity. If you don't have enough reserves where you can't afford to be illiquid for a period of time, it's going to be kind of hard to get in there. That's the main reasons. But if you overcome those things, there's going to be almost always higher or more favorable risk adjusted returns for your portfolio.
Yeah, and I think there's a few other aspects too of that. You bring up liquidity, and that's definitely a good thing to look at from a few different perspectives. One, I think people in the private equity market inherently are making more informed decisions, and I will say it till I retire, is that the informed investor is the more successful one.
Right.
Inherently, more informed you are, the better research you've done, the better you are going to do. And that's not financial advice. That's just basically saying if you know what you're doing, you're probably going to have a better result. So again, making those things, because private equity inherently you have less liquidity on the provider side. Like the people that are doing it have a need for liquidity. That's why they're raising capital. And two, from the investor side, these are typically highly illiquid assets. So you're going in with the knowledge base of saying, hey, look, like if this thing goes bad, like I'm on the hook for what I'm doing, as opposed to the stock market. I can set a trailing stop loss and say, okay, cool. If it hits $20 a share down from 28, cool, I'm out, and I could be taking a nap and it happens, right? There's just that kind of like separation and disjointedness from the actual investment that you're doing that I think leads into some of that again, missing out on returns that people have. And secondarily too, there's a lot less impetus for these companies to dilute their investors' value. right? So, a company on the stock market could be like, hey, we need liquidity. Well, let's issue a new series of common stock. Let's pump it out there. Let's have a stock split. Let's have a
Right.
3-to-1 split. You don't really have any control over that. Whereas with these companies, like if you have enough capital in them or enough people, you can come to the door and be like, no, 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 this is not happening. Or
Mhm.
again, you can have a realistic expectation and conversation with these people about, hey, here's why we need to do it. Okay, cool. Well, maybe I'll give you more money, right? Instead of having my position diluted, let's increase my position because it needs to get us over a finish line of, whether that's like a drug approval or a medical device or, they found a sinkhole in your commercial property, right? It's all these things are again a little bit more hands on, and you have a more informed investor base that can again make better decisions. And I think that leads into maybe some of those performance metrics.
Right.
It's why these things do better is again, it's impossible to actually answer, but I think these are definitely some very salient points. And where I'd like to kind of maybe transition a little bit is, you bring up, the Jobs Act being accredited for some of these things, and that is unfortunate. The Jobs Act opened up, going from 506B to 506C, and how these things can be solicited, how people can find them. It kind of trimmed the hedges on that walled garden, but it didn't kind of take them all the way to the ground, right? It's not necessarily every civilian can't go out sometimes and invest in private equity, because again, if you've never read a prospectus or a PPM or a set of subdocs, big bold letters, all these scary risk things about losing your entire investment, and there is risk. So we've talked a lot about the real good parts of private equity, but from the risk standpoint, how do you kind of take that in? And maybe the question I'm asking is that if you're trying to educate someone on the fact that you have a relatively illiquid investment that can carry just like any investment risk, how do you kind of provides satiate their need for security while also kind of being practical in the fact that illiquid, potentially risky, has some compounding factors to it.
Right. Well, there's definitely risk in everything. It's just what type of risk do you want to take? Like you were mentioning geopolitical, we talked about real estate and the interest rates, volatility risk. So when you do invest into a private market for, let's say, for example, biotech, let's say you're developing a drug. Well, what if you don't get through the clinical trials and some drug is found to be toxic to your liver and your kidneys or something, right? That's that risk. Now, let's say if you're an expert in livers and kidneys, you've got, nephrologists on board, and they're like, well, this molecule is pretty similar to this other drug that's on the market and doesn't have any effect on the kidneys. With that specialized knowledge, you could be like, yeah, we're probably going to pass these clinical trials. It shouldn't be an issue. Or for example, if you're doing a med tech, I'm just speaking life sciences because it's just on my mind. But in a med tech company, for example, we invested in a filter that with a blood draw can capture cancer cells in your blood enough to diagnose you and screen you for over 200 cancers. It's the only test in the world that does that, by the way. So what's the chance of this not getting approved? Well, they already have not only ways to use this filter already, but they actually use it in almost like a dialysis type machine at universities to capture enough cancer tumor cells to study it under a microscope. So we know that that already has passed FDA use. All we're changing is the filter and making the holes a little bit smaller. What's the risk of not getting FDA approved over time? It's going to be pretty low once you really know the science about what's going on. And so in every industry they have its risk. For example, if you are doing e-commerce, you're doing anything on Amazon, there is the risk of sometimes getting suspended if your health metrics are not met, if you're not meeting your delivery times and good products and customer feedback and things like that. So every industry you have to just understand what the risks are, and then I like to bring in an expert if I'm not the expert myself and say, hey, what's the real risk in this industry? I'm trying to do this and this, because I'm not going to be the expert at everything. But a lot of times when you go through the private placement memorandum, which it outlines the risks of a private securities, you could go through every single segment with a consultant and have them kind of explain, hey, this is kind of high chance of happening here. This probably will never happen. And that's how you get a feel for what the risk is. And that's pretty much as good as it gets. Like even in the stock market, they do put some numbers to risk. Like you can have your alpha and your beta and see how much uh, extra you're getting paid for the risk you're taking and things like that. It's hard to do it in the private markets. So this is pretty much as good as it's going to get.
Yeah, and another thing that just kind of popped into my mind when you're talking about that, as far as we're talking about risk and reward there too, is especially I was just kind of thinking about, medical, devices and drugs and things like that. One of the things that the key thing that we're talking about here is diversification. Well, it kind of plays the lack of diversity in the company's actions that you can invest in the private market can play to your favor quite well as opposed to investing in the public market. So many of these companies are conglomerates now. GE does not just make, general appliances. They make, heck, they make missiles. They owned a movie studio for a while. Johnson and Johnson doesn't, they made baby powder, but they also made toothpaste, and then I can't remember what all else is held by them, but a ton of stuff. You have the ability for the diversification to play against you sometimes in the public markets because if something like a big lawsuit happens, like baby powder, or you have something where a jet engine isn't getting bought because the 737s are grounded. Well, it could affect them negatively, whereas opposed to here, you really get to focus on the core product and service. And again, getting the advice is the important part here. And I actually just
Right.
went through with an investment that actually got rolled over from an old pension of ours. It was kind of the opposite of that. There was risk, and the drug actually didn't make it through clinical trials. And now they're in a real tough spot. Again, I wasn't a party to the actual investment, and everyone seems to be okay. They've made peace with kind of what happened, but again, it just highlights that there can be risk with this, but you get to look at these things much more on a focused basis, and I think that's really good to have some of that specialized lack of diversity in what they're doing, because once you get so big, then so many different things can affect it that are so far outside of your control. These small private companies aren't diversified conglomerates that do manufacturing and then have seed production and all sorts of other stuff. So again, I think, at least from my perspective, that can actually play to a benefit of some of the, kind of inherent security that private equity may offer. What are your kind of thoughts on that?
Yeah, I mean, that makes a lot of sense. I like the part where you talked about, the lawsuit type of risk. Because I just came across some article. What was it? Somebody was just going. This is like literally this morning. Somebody was going public, and there was some lawsuit, and now uh, they're declaring bankruptcy to get out of that lawsuit. But I was like, that was a big risk. It was some restaurant chain. I can't think of it right now. It's a
Oh
restaurant
man,
I've been to.
I want to say I
But
saw that come across on like my feed of something. I saw like restaurant and lawsuit or something.
it wasn't it wasn't Hooters, but it was one of their competitors. That's all I remember.
I
So
think it might have been Twin Peaks.
yeah, actually it was
Yeah,
Twin Peaks.
yeah.
Got it. That was literally just
Yeah,
today.
real clever
Uh,
with their naming on that one.
yeah,
But
yeah.
it's
And now I kind of got sidetracked. I forgot what we were talking about before, but
yeah,
uh,
but again, it's just kind of interesting to look at these things. And that's one thing I really like about the alternative space that there's so many different avenues. One, to make money, because again, it's not necessarily just saying, "Hey, I want to invest in real estate." Okay, cool. Well, you can invest in single family, you can invest in multifamily, you can invest in industrial. Like, okay, great, those are three main avenues, but you could do fixed income debt, you could invest in hedge funds like the gentleman I also interviewed that does kind of like a hybrid hedge fund, large controlling LP interest investments. There's so many different ways that aren't as complicated as the stock market. Like, you want to start doing different investments in stock markets, you better have a degree in math and physics, because looking at like option desks makes my eyes bleed. If you look at like an options,
that's usually a full-time job too.
yeah,
You'll
it
be
really
staring at a
is.
computer screen.
I'm interviewing someone, I believe, next week that developed is developing trading algorithms for options and data management. And literally, they
Huh.
have two of their managing partners have PhDs in physics. Like,
Yeah.
it's the nice thing is that you can use your degree in whatever it is. Again, you don't have to have a degree. Your experience in life in the private equity realm much better and much more acutely than the public market, in my opinion. And I think that really kind of drives home, the potential returns that you can see. And again, no investment's guaranteed, but if you just look at the comparative analysis to what private equity has done, and again, this is not what it will do, but what it has done, and what the S&P has done, not what it will do, you can see those stark contrasts in your rates of return. And again, hard to calculate the risk adjusted return for the public markets, but when you start looking at that, I think when you start doing the risk adjustment, it's pretty attractive.
Yeah. Yeah. And, another thing that's kind of a misconception out there, I was just thinking, is that people are probably thinking that the public market is bigger than the private market, but actually 87% of companies that are worth over $100 million are actually in the private space. That's 87, almost 9 out of 10 companies. So most of the wealth in the world when it comes to business is in the private space. But now, how much of your portfolio is in businesses that are private?
Yeah.
A lot of people is almost nothing, but they'll have almost 100% of their retirement account in the public market, right? Which is just 1/10 of businesses in the US.
Yeah, and if you look at the reasoning behind why companies go public, one, it's for the benefit of the primary shareholders and any initial shareholder, which if you're in the private market, you get to take advantage of, or just a need for additional liquidity that otherwise really wouldn't be available in the private side. So again, you can take advantage of part of that, but once things are publicly traded, a lot of those benefits go away. And again, to your point of large companies being private, I mean, I have at least two very close friends of mine that work for companies that are private that I think one has a current valuation of like 28 billion. I never heard of the company before I started working for them. They're in
Hmm.
tech, but again, it's just there's a lot of money and value. It's not just mom and pop outfits or inherently kind of flighty things. Like there are companies out there. I mean, Cargill Foods is private, right? Like big companies that you have heard of might be private. And again, just kind of goes to show it's like there's a lot of value that is in the private market, and why not take advantage of it?
Yeah,
Um,
yeah.
yeah, so I mean, want to kind of bring this in for a landing. Again, there's a little bit of a different trajectory of a conversation than I think we initially thought we were going to have, but I think it definitely brings a lot of value in the highlighting of what it means to have non-correlation in a portfolio, right? It's not just again, throwing the dartboard, throwing your darts at the paper with the stocks on it. It's getting outside the scope of what everyone where everyone else is, right? That's if you're going to try to create value, don't go and try to get the same slice of the pie as every single other person. Look outside because those are where you can get bigger chunks that are going to potentially be more suited to your goals. So again, any kind of closing thoughts on really what you'd like to drive home for people about kind of the alternative space and how you operate there?
Uh, Maybe just a few things. Even though you're a passive investor, being a passive investor does take some action. Actually, you have to go out there and look for these things. To be a good passive investor, you need to turn every stone. Especially when we talked about private equity. The average IRRs in private equity is 27%. In our life sciences fund, we're tracking 38% IRR right now. There's good reasons to be looking into that. And if you're not sure what to do, I mean, definitely listen to podcasts like this one. Go to some meetups in your city and see what you could find in these other asset classes like private equity, private real estate, and private credit. Those are the main three categories. And then, a couple things too. If people want to learn more, I just came out with my second book called Prosperity Prescription. We talk about some of these things in there. And sometimes people are thinking about investing, but they don't know where to start. And if somebody is listening to this podcast, I'll offer up somewhere a link around here a chance to do a one-on-one clarity call with me, just 10, 15 minutes. If they're confused about something or something doesn't make sense, maybe I could help put them in the right direction or share some resources that I have. But having this be like a team sport and working together, reading more, learning more, and being an informed investor, like you were saying, is really the key to being a successful passive investor.
No, absolutely, and I really like, the point of, it's a team sport that you really don't get in the public markets. The private markets offer the ability for that, hey, we are all in this together. Let's make this work. And when you have that, you don't have hawks coming in and making massive short positions that are going to drive down the company you're investing in, right? You get to play a team sport and try to help make everyone successful. And when everyone's working towards that goal, which quite literally is the opposite in the public markets, you have people actively working against short sellers and people that are writing crazy option contracts. You don't have that. So again, risk mitigation. You get rid of that. You get to play. You get to be with people that want the exact same outcome as you do. The company does, and every single investor that put their money in there wants it to succeed. And when you have that kind of collective positivity of everyone that's putting their dollars in, again, in general, I think that leads to more favorable outcomes. So again, really appreciate your time today. It's corny as it sounds. I like to always end with saying, the most valuable asset we all have is our time, because we can't make any more of it no matter how studious we are with our investments. So Amir, really appreciate you being on with us today. If people want to reach out, I know you also manage Baluch Capital. Where can they find you? How can they reach out?
You can start at baluchcapital.com and send a message to us. You can find me on LinkedIn, Amir Baluch. There shouldn't be too many Amir Baluches on there, I don't think. At least not that many in Dallas, Texas. So, and then probably somewhere on your podcast, we'll have a couple links if you want to do a one-on-one call or get a free copy of my book. Wherever we can help you with resources, we'll try to do that.
Yeah, absolutely. I like you, also have a name that no one else has. I know that for a fact. It's not the craziest name, but there are no other Alex Pernys out there. Well, again, I really appreciate your time today. Again, everyone, thank you very much for being on with us today. We really appreciate you're listening into the podcast. Again, my name is Alex Perny. This has been another episode of the Alternative Investing Advantage podcast. Thanks, and have a great day.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.